Yeah. Hi, everyone. Welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. I'm joined again with the research team, Ehsan, Vincent, and Audrey. And today, as normal, we're going to talk about the oil market in particular, maybe a bit about gas and other commodities. But I think it's a pretty interesting one for today because we are deciphering what's going on in oil markets, and there's a lot on the table to decipher. There's games going on. There's, different things going on with different products. So we're just going to launch into it, hopefully have a bit of discussion and kind of figure out as we talk as well, which is hopefully quite nice for the user. Just as a reminder, this is filmed on YouTube as well if you want to see our dynamism in face-to-face as well as audio. So why don't you start off, Vincent? What are we talking about? What's the new information in the market that's interesting?
Of course, we're talking about our usual favorite, the OPEC and announcements relating to that. So yesterday, new headlines, Saudi and Russia would be making continued cuts to their oil production. Saudi will be continuing their July 1 million barrels per day production cut moving into August, while Russia will be continuing their initial voluntary 500k barrels per day production cut. So just when sentiment was turning into very bearish for Brent futures towards the end of June, this headline for the first trading day of July was more of a bullish one. Just when people thought Brent was going to collapse down even further, the Saudis came into wanting to continue supporting, or as I quote, stabilize the oil market. So yeah, very interesting headlines.
Let's start with what the actual cut. Let's get specific because I think this is very important. And Audrey, I'll get you to do this. But before, the context is we were expiring. So basically, literally Friday, we were expiring the Brent contract, the front month Brent contract. Very important because it decides the time spread value, which is the implied physical differential, literally where physical it's exchanging hands relative to the benchmark. So it's a very interesting kind of number. That comes in at minus 20 cents, which is actually a bit higher than we were expecting because the dated Brent market right now, or at least last week, was around minus 50 cents in the physical differential. So it would all look like it was heading south, looking quite weak, specifically in the North Sea. All of a sudden, expiry is a little bit higher than expected, and then we get a rally on the back of this news, and we can go into that. But Audrey, what about the actual announcement itself?
Yeah. So the two things coming out, so obviously Saudi Arabia continuing with their 1 million barrel a day cut into August, and then Russia announcing their 500,000 barrel per day cut to exports. So there's two things I found really interesting about this. Yeah. I made a comment to Vincent and Ehsan yesterday about the Saudi Arabia thing, and my comment was, well, did the market actually have this priced in? And the reason I made that comment was, I don't know, do you two remember, but a month ago when they announced the first cut, I think I put this in a report and we took it out because somewhere else it said, no, the cut was for July. I remember reading somewhere that the cut was like for an unforeseen period of time. I read that somewhere for sure. And then it came out, no, it's just for July. So I'm thinking if I read that somewhere, so did definitely some market participants. Okay. So I'm thinking, when do the market have this priced in potentially already? I mean, it only rallied by like $1 in the immediate like aftermath of the news coming out. So that was one thing I thought was kind of interesting. And the second thing was obviously the Russian cuts are to exports, not to production. So if Russia's still producing the same amount of oil, I mean, that just means that like 500,000 barrels per day is not coming onto the market, but it does mean that they can refine it, in Russia and just send all the products out, which again, I don't see how that is super, super bullish for crude.
That's really interesting because again, that distinction, why are Russia now helping out OPEC? Because I think one of the other narratives that was building up was we've gotten to the extension of what's possible to cut, realistically possible, before you go like nuclear, right? So Russia all of a sudden are saying, no, we will help out. Why do you think that is? Probably from the recent failed coup or the civil war type threat that was happening. Off the back of that, want a strong stance. I think having allies is a good idea, obviously, in that scenario. It felt like an olive branch, more of a geopolitical stance. So they're now back into the table. As you said, quite a sneaky way to put it though. Yeah. What are Russia actually doing? They're actually saying, we'll give up 500,000 barrels per day of crude market share for Saudis to take back because we've been taking your market share to Asia. That's a possibility, right? So they've been giving that market share back essentially. But as you said, they can still refine it and export as much as they like.
Yeah, and there was another kind of article, I think this came out today, this was on Reuters, about Russia's seaborne diesel exports rise in June. So that was obviously after the refineries have come back now. So refineries were undergoing maintenance up to this point anyway. They're all now coming back online. And the country's like, oh, hey, we're going to take this crude, but they have refineries coming back online now. Why not just refine that crude themselves and send the products out?
Very clever.
I think Vincent also has a story about that Swiss story that came out as well.
That's a Swiss story. That's more on the sanctions and stuff because of the price cap, because of the embargo. Of course, you know, the big companies, the big trade houses. Of course, they must be avoiding dealing with the sanctioned Russian oil, and of course, you know, before that would have been with Iranian and Venezuelan oil, of course too, because of the sanctions and the consequences if they were to be caught doing that. So I believe this time it was one of the smaller Swiss trading houses, and it was the first time the EU would be conducting an investigation into it. So yeah, we'll see what happens from there. But
yeah, it's a little bit of a tangent. We'll talk about that a bit later, I think. But just sticking on this, Ehsan, you got something to add on that?
Yeah, I mean, like looking at the actual price moves on the benchmarks, this time we had kind of a reversed reaction by the market with the news. Last month, when OPEC announced 1 million barrels cut, we saw a real weakness coming into Brent Dubai, so the difference between the Brent benchmark and the Dubai benchmark. But this time, even though the Brent Dubai differential was very, very, very weak, it seemed like people are using this headline as a liquidity opportunity, all the shorts.
In Brent Dubai?
In Brent Dubai. Because market was massively positioned short in Brent Dubai. But now, with the expectation of more sellers coming in, you know, all the shorts wanted to get out of their position. And it wasn't that much selling. That's why the price kind of found a bit of support and came back to the positive levels again for the Brent Dubai differential. And also, there was that you know, the strength in the Dubai market that we saw initially last time. Similar sort of pattern happened, but definitely it seems like now, at least like on a relative value basis, Brent is holding up again off the back of the expiry. You know, the strength in the dated market, the North Sea strength filtering into Brent. So the levels seem to be retracing and correcting back higher on the Brent Dubai. But one other thing that I've realized was, you know, across the tenors, the Brent Dubai market is very much positioned on the long side, even though that in the front there is a lot of selling, but if you look at across all the tenors, August onwards onto next year, our data is showing the market is more long than it is short, and if the prices keep on going lower, we might see, you know, people defending and not letting Brent Dubai sink further.
Yeah, it's a bit of a weird dynamic. So, you know, OPEC cut, and it's not like, I mean, even talking specifically about cut, that's yet more depth they're going in. Like, we never thought they would cut for the fourth time and in a row and go so deep into their pockets to hold this market up, but they are. And I think the way I felt about it was when the cuts were announced previously this year and late last year, it was over the weekend. And so what you got was like an immediate flat price reaction. This time round, I was not too worried about it in terms of like, I didn't think the market impact would be that big because the original July cut from the Saudis was effectively immaterial because July barrels were trading and they were trading weak. And actually they were really struggling to compete with all these WTI Midland barrels that were coming into the dated Brent market, which was pressuring the Brent complex. In other words, US exports were like basically a match for the cuts in Saudi. So
that's interesting because now I think so. That's a very interesting point. But now that like OPEC has done the cut, what you see in the weekly export numbers out of the US, that has reduced a little bit. So it means, to me, it means that, right, let the market decide where the price is. We don't want
the demand is, at least.
Yeah,
we're
exactly.
not going to export if you're not going to buy it.
Exactly. So like we don't need to like go crazy with the export numbers out of US to put a lid on these prices.
So that was happening retrospectively, though, because when you look at export numbers, when he's talking about like
for the last 4 weeks.
4 weeks.
Yeah.
So we're not quite into July barrels. So my point was July barrels were being traded in the deferred market, which settles the prompt data Brent contracts. So my point is that from how it's going to impact, because Audrey, you're saying, how is it going to be priced in?
Yeah.
Well, July barrels are already priced in. So the July physical barrels have had their maximum impact on derivative prices already. Mm-hmm. This was new news because it's now August barrels. Mm-hmm. So no, we're going to do it again. Like, whoa, shit, because we were actually slightly overhung by the marginal barrel because of US exports and of the expected July exports from the scheduled exports in the US for July barrels. Now we're talking about August. Well, actually, you took 30 million barrels offline, and that proved to not be too big of a deal. But now you can do another 30 million. This is now having a marginal impact or effect on the marginal barrel. Mm-hmm. It seems like that's what the North Sea oil traders decided. We've done with the July cycle. It's priced out week. Now we're looking at August. Oh, actually, another 30 million barrels offline for this month. Do you know what? I actually think this is going to be a little bit tighter. So we get a wave of buying on Friday post expiry or during expiry, then again on Monday, yesterday. And that was unusual and different. What I was saying before was the first time was over weekends and it was more of a shock and awe type thing. This time round, it wasn't over the weekend. And it was probably like, they probably felt like it wasn't a huge headline, but it actually materially made a difference to the North Sea oil traders trading these barrels going, well, you're taking another 30 million. I actually think this is going to have a material difference. So that buying filtered into the Brent spreads, which seemingly filtered into the Brent flat price. We had like a pretty decent rally, $3-4 in a couple of days. Like that was almost like a stealth rally. And now all of a sudden we've got this bullish momentum. You've got like technical levels approaching, right? Alex Longley from Bloomberg, was saying like it's approaching
the 50-day moving average.
Yeah, so this looks like we could be getting this breakout territory finally, right? Which is a big surprise to me at least. But then your point about Brent Dubai, Ehsan, it's like, well, Brent Dubai negative shows you how much stronger Dubai is, obviously. And it's very rare for it to be negative, but it shows you to the extent at how much these cuts have been done. But now it's a weird thing because you're saying everyone's position long Brent Dubai. Just historically, it makes sense. You just get long at negative numbers. Your risk reward is pretty good. So then it becomes a bit more about freight. Freight is kind of high, but it's also kind of low depending on how you see it. So like outright numbers like might be in terms of what they need to be low enough essentially to warrant the arbitrage. That's how you need to look at it. The freight numbers relative to the arbitrage levels, not outright freight numbers. You see what I mean? So if they're cheap enough for you to be able to buy the Brent Dubai and do the arb, then it's fine. Freight's low in effect because it's accommodating the arbitrage. So I think freight is low enough to potentially boost more, Brent related crudes going east, which is therefore supportive for Brent Dubai. So ironically, it's finally gotten to that point where the cuts are deep enough that actually Dubai might be so strong and the Brent Dubai so weak and the freight low enough that you can now finally have a global impact. And it will only have a global impact on prices once you impact the Brent benchmark, not just the Dubai. So that I think is the key change this time round. So your point about Brent rallying, Dubai actually weakening in the first day of settlement, and like loads of cargoes being sold last month, just not performing quite as expected. That's actually kind of logical. So it's finally, I guess that's my overall. That's why it feels different this time. It was still a bit of a shock. So I guess the next thing we need to go through is why we were bearish in the first place at the back of North Sea, the NATFA complex, coming into the NATFA complex, and what changes now. So do you want to talk about that a bit?
Yeah, so this was in a report last week, and if anybody listened to Market in a Minute, we kind of also touched on it. But basically, I think prices are still coming off in NAFTA as well. I mean, this is kind of stemming from, a lot out of the East, and just with like petrochem margins are really bad. The demand for plastics isn't quite back to where it was. Obviously, the demand for gasoline is up so high, so all the refiners are running gasoline to the max. On the back of this, they're overproducing naphtha, so there's an oversupply both sides of the Suez of naphtha. Prices have been just absolutely tanking. In terms of what that meant for the North Sea is obviously with Midland now setting the North Sea prices, that grade in particular is really naphthenic. How do we pronounce that word?
Naphthenic.
Yeah.
Really naphthenic. So essentially, the refiners don't want that. Where there are good margins at the moment as well. We kind of were discussing this in house yesterday. Is fuel margins are really good right now, but obviously the grades you're going to want for that are your more heavy, more sour grades. So people don't really want those lighter sweet grades that are producing lots and lots of naphtha, because the margins for that at the moment are just, chronic. Refiners don't want it, and that has been seriously weighing on prices. We were talking yesterday then if those prices were to recover, and we have seen steam crackers in the east popping up again and kind of taking some of that supply, but not to the extent that has had any effect on price action yet. They've still been tanking, and I guess refiners are still running gasoline to the max. I think there's going to have to be some run cuts or some kind of change there before we're going to see.
Which is then bearish crude.
If they run cut for no one's going to want the crude.
So the question is, I was trying to mention this on WhatsApp yesterday. It's like the story we had is that naphtha is too low. It's all about the marginal barrel that sets the derivative benchmarks. The derivative benchmark that's key is Brent. Brent is priced at the moment by WTI Midland. Midland produces a lot of naphtha. Naphtha's dog shit. So it's just going to weigh no matter how tight the market is. But my point was, there is a level where the overall net supply gets low enough that it has to filter through even into the marginal barrel. But you're really squeezing the margins, like the refinery margins, as you said. Like, what are you going to produce? You're going to produce you're going to refine heavy crudes because the fuel oil crack's fantastic, the distillate crack's good, the gasoline crack's good, and you get a bit of that. But the naphtha is crap, and by the kind of token, the propane is as well. So like, the question is, what OPEC have managed to achieve is finally like a clearance of those WTI Midland barrels, or at least giving them some support. But it's just how long that can last, because the naphtha crack needs to rally. Otherwise, you're going to get poor light sweet margins again, and the same thing's just going to happen.
I think they're still tanking today.
Naphtha is also comes a lot out of the Russia as well. Big heavy naphtha traders. It's all about naphtha basically in my mind. But I think, what would you say, Vincent, about like the story of naphtha? Can you see a bullish argument? Because what we're quite clearly saying is, if there's a bullish argument in naphtha, you have to be bullish crude.
Yeah, there's a couple of things. So notwithstanding there's some strength in Eastern naphtha benchmarks right now. The MOPJ is pricing quite strongly, but then European naphtha hasn't really been following suit. But what was an interesting thing from before that was discussed was the difference between the European gas nap versus Asia gas nap, and the fact that the European gas nap differentials was actually much higher than its Asian counterpart, partially due to the heavy premiums for heavy virgin naphtha, because of the Russian sanctions on Russia. Russian naphtha is still making its way into the east, but on the other hand, trade houses, the oil traders in the west, they don't want to be touching Russian naphtha for obvious reasons. Therefore, the market for heavy naphtha is tighter, and logically, the gas naphtha for Europe is higher. So that's one thing. But then overall, naphtha cracks have been quite weak because of weaker petchem demand. But you got to make the there's a difference between the heavy naphtha and light naphtha. There's we can go into all these chemistry lessons and whatever, but overall, the Eurogas naps, there's a difference, but at the same time, the entire naphtha swaps complex has been really bearish and uncharacteristically bearish.
Does this not tie back into like the fact that Russia is only cutting exports as well? So if they start refining their own crude and start flooding the Eastern market with more naphtha, you're not going to be able to clear naphtha in Europe. You're not going to be able to arb that East.
That's it. I mean, the East-West is doing what on naphtha right now?
It's rallying.
But where is it level-wise?
$7-8 in the prompt.
Okay.
So yeah, I think it was apparently there's some short covering. It was driven by partially due to financial flows. So
yeah, 750 has come off again from this morning.
Yeah, but what I was going to say was in terms of like people putting bets, like the bets, especially over the last week or so, has been all more skewed towards the long side for NAFTA. As in, like, people are buying it because it's cheap, and I guess because also there's this other fact that like the current open interest has kind of moved a bit higher than the last 5-year average, and that kind of gives us the implication that there is some sort of speculative flow in the market that came 2-3 months ago when NAFTA became really, really weak. So this new flow that is not so much related to hedging and the normal activity that is in the market, they all are positioned long for NAFTA, especially for Q4 tenors, especially at the back of the curve. People are buying NAFTA cracks in hope of the levels like correcting back up. So that's where people are placing their bets. So I guess if we continue to see the weakness kind of rolling, it might actually get uglier, because now you've got a market that is skewed towards the long side, and the levels are continuously getting weaker. So like stop outs and like.
Well, only thing I would say to that is what can help NAFTA derivatives prices is gasoline weakening, and I think gasoline has been weakening. I'm just having a look at one of your tweets.
A little bit, yeah.
From a couple of hours ago, Audrey. I mean, these are fantastic now. But like that's key, right? So do you want to go through that?
Yeah, no, it had. So we talked about this in the monthly report. I'm not sure, did we mention in the last podcast? We definitely mentioned it in a couple of reports. But yeah, I mean, it seems like gasoline has kind of like reached its peak levels. I think it's still going to be strong for the next couple of weeks. But what we're seeing a lot of is, loads of profit taking. I mean, for the August contract, so the now prom contract, the people that entered, 12 months ago and 3 months ago, they entered about, $14, $15. So at that $20 per barrel level for that front crack, that's massive profit for them. So we're seeing lots of profit taking. So even if people pile in long, what seems to be happening recently, the kind of trend we've been seeing is, we're seeing length being added, prices rally, people take profit, prices come back, people scale back in, buy. But it's not like breaking like that $25 per barrel level. It's not like ripping super, super significantly anymore. So people are staying long and staying bullish. But once they're kind of in the money.
July crack or
that was for crack. August.
So this is key, because a lot of the second half demand story has to filter into a product. Otherwise, what is, that's what we buy. Gasoline was the big hope, and gasoline is a light sweet, output from light sweet crude. And I think that there's just a lot of hope on this crack. And as you say, it's kind of reached its kind of psychological level of $20 where it cannot really get past materially. And there's, it's gone down to 18.25 from 20. That's a big move down.
Yeah.
But I am also saying that kind of helps the NAFTA complex. So it just kind of these flows just kind of need to equal themselves out to accommodate the margin. But so that you just cannot hide from oversupply and undersupply, generally speaking, in oil markets. So it's just what we're trying to decipher is if there's enough net supply decreases and there's not enough supply in the world, then these cracks should figure themselves out. But they are fucking weak on naphtha and weakening on gasoline. At the moment, it just seems like all you've done is tighten even further the heavy complex, and US are still pumping. I know you said the exports are slightly down, but July exports, from at least when the data Brent trading has showed, is that they're going to be high. There's a lot of barrels that exchange hands at quite low numbers for July. So that's going to show in the numbers in the next couple of weeks. In the physical
but when I say like low, I mean like lower.
No, I get it. I'm just saying because that's the beauty of the swap markets, right? We can see the physical changing hands. So we now know that the US export numbers will be quite strong again because of all the WTI Midland that was exchanged hands for July. Yeah. So the US don't look like they're stopping. The US are going to keep exporting. I just don't know why everyone ignores this shale oil point. Like everyone's at shale oil, they're never going to increase more. Like we're record productions. I just don't know why no one mentions that. So I don't think they're stopping, right? So all you're doing is, yes, for a time being, it does genuinely seem that there is just not enough supply, that it's finally kind of got to that critical point where we have tightened just enough, right? But it seems temporary, because I don't think that light sweet flow is going to stop. Even if it's just a little bit marginally increasing, you're at the absolute extremities of a heavy cut. So it again goes back to that's what the cracks are telling us. So it's just at one point, like if there's a big sell-off in gasoline, for example, like you're just that's going to demonstrate that look, that even with the Saudi cuts, the US have produced enough and whatever else, and we are fucked. So everything's in balance right now.
That to throw a spanner in that works is the Rhine water levels. Do you remember last summer they went down so low and it absolutely tanked the NAFTA complex because they got stuck in the ARA, so stock just built and built and built week on week on week because it couldn't move. That's a good point.
So you're saying that's a big contributor to the weakness.
So we've just it hasn't happened yet. So that's the point. Like it's coming. So we did see I'm just looking at an article now.
It could get worse.
Yeah, it could get worse. So they currently remain passable. So we're seeing rain rises, Rhine water levels in Germany north still too shallow. So obviously if those barges start becoming like really, really expensive and we start seeing a buildup of naphtha in Europe, it's going to tank naphtha prices in Europe even more, like we saw last summer.
But that's not the same as the crack. That's the problem with that narrative. I understand what you're saying.
They still did tank last summer though.
No, I get it, but I'm like absolutely valid point. It's just that's the weird thing about derivative pricing on crack basis. At the end of the day, it's just accommodating a margin which is feasible. So if gasoline gets weaker, naphtha crack can get stronger. It is kind of a virtue of it's literally naphtha versus Brent, gasoline versus Brent. It's a relative value thing. You're talking about the physical diffs in particular, which affects the time spread. So you're saying that could still, and that would be a great indicator. I'm not saying there won't be selling pressure on the crack with that. I'm saying to Ehsan's point, a lot of people coming in and buying ridiculously cheap naphtha cracks. It's like that might actually just that wall of buying will allow it that kind of floor. The negative diffs can still be negative in pricing or weaker and weaker and weaker. But his point is if there's all this material buying, it will just hold a floor. And then it's actually gasoline that will have to correct to allow for that floor. But either way, that's still very bearish. So I guess we have to just be talking about the light complex as a whole. Incidentally, where are the pronaps? Not to put you on the spot.
Pronaps.
But is your market on pronaps?
Minus 118.
How have they been doing since the naphtha sell-off? So if you go back
pronaps have really strengthened.
Propane has been super weak though. It's I think we can't ignore the fact that propane has been struggling the whole year with stocks really high and like export numbers quite decent.
But again, it speaks to the light sweet story in the US.
Yeah, in a way, I say like, but I wanted to. Sorry, I'll get to this, but I wanted to like touch on the weakness on gasoline first, especially in the US, because looking at the stock levels in the US, they are still lagging behind the 5-year average. So we don't have enough. They don't have enough stocks in the US. However, the prices have come under pressure. Rubber has sold off, and all these derivatives markets, they are a lot significantly smaller than RBOB crack. So in a way, RBOB crack is the mother of all of these curves. When we talk about the European gasoline, when we're talking about the Eastern gasoline, etc. And the weakness that came into RBOB crack, it was quite interesting because over the last few weeks, we've seen money managers actually exiting their length in RBOB, something that they had kept on for a very, very long time, being long in products and getting out of their crude positions. But now they feel that this is kind of overdone, and it kind of goes back to the demand story more than supply, because looking at the fundamentals on the supply side of things, stocks are low. Refinery run rates are still quite decent, but still US generally at this time of year needs a lot of gasoline, needs a lot of product. But still money managers are seeing, this is overdone. The levels coming off in RBOB crack, and it gets filtered into EBOB and the rest of the complex. So for me, the one to watch, for seeing whether these weakness is going to continue is, looking at the money managers' positioning in RBOB, and whether they're going to bet against gasoline prices to come off further or not, and that's gonna, really derive the weakness in the gasoline benchmarks and the weakness. Creating that support that naphtha needs. So yeah, that's that was my 2 cents about gasoline.
No, look, it's proper interesting. It's like derivative and physical at play, basically, to like decide what happens next. But one thing it does feel, it's just a propped up nature of it. But like, if we think of it like QE, like quantitative easing and central bank policy equivalent, you can prop up a market and it can eventually work. It's just, can it work in time for the increased demand? So the demand thing's been weird. I think we could talk a bit about China, and I think we should. I just have to also, I've just been looking as we were talking about the shale oil numbers as well. Like the EIA are like, yeah, do you know what? It's going to increase more than we actually said. And by the way, it's going to be a record this year and next year. I just don't get why no one talks about it, because everything we've been talking about is what happens when there's an oversupply of light sweet crude oil, which is coming from shale. You get low naphtha cracks, you get low propane, and you get an oversupply of light sweet crude. And it's completely logical. So why does everyone just ignore it? I just find it really, really weird. But anyway, I get your point about RBOB as well. Like, it's just that US kind of driver summer demand has always worked out for the market in Q3, and everyone's relied on that once again. But it just, this is where the demand comes in. Is that going to be what saves the market? Because it needs to absorb all the gasoline in the US that's produced. It needs to absorb the light sweet complex and blah, blah, blah. And then what about China? Like maybe a lot to do with petchem reduction in demand, like you were saying. They've got now their blending component tax. Does someone want to speak about that, like the more in the detail? It's basically they're just taxing more like things like butane and naphtha, I guess, to blend into gasoline, right? And other things.
I think we can talk about the so Refinitiv data about China just on the crude side of things, and then we can move into products.
Okay, yeah.
Because the Refinitiv data in just crude imports in China showed really, really strong numbers. That's like, it was the third highest record for like importing crude. That was in June. That was like 12.5 million barrels per day. And generally, in comparison to previous years as well, it was quite high. It's been the highest in 2023. And the general narrative in the market is that like China is getting a lot of blame for why the demand is not recovering, while the hard data is not really showing that the crude import by China is lagging behind. So like they're kind of doing what they were doing before, a bit more in terms of import, but the price continues to tank. And comparing that with what people are putting out there, right? China demand is not as good as previous years or as good as we anticipated. But the reality is the numbers are telling us, at least like in June, the import was pretty decent.
Okay.
So why is it that demand out of China not getting filtered into Brent futures? That's and people continue to blame the Chinese demand not recovering.
Okay, so you're saying they are, and so people should stop using that excuse.
Yeah, exactly. So like,
so people love a demand story.
There's a couple of like excuses that like everybody keep on using. Like there's the interest rate, there's the fear of recession, there's the China demand.
But you think it's actually a supply story?
I think it's a lot more complicated than that. That's what I'm.
That's very politicians answer.
Yeah. Because I think it's too easy to come out and say, right, there's this element not working, so that's why the price is doing what it's doing. Well, these markets are complicated markets. There are so many products, so many different variables in play, and you've got to completely understand this network of variables to be able to create a narrative that is meaningful. You can't just like take one leg and be like, right, this is out, so the price should go up. It doesn't go up.
But there are it's when I think you're in a propped up market, there's someone's propping that market up. So who's paying the cost for that to be propped up? Now, because the market always wants to be bullish, I've had a few haters on Twitter who made that clear as well. It's just it's funny. But the point is that a lot of what you've got to do as an oil trader, right, is decide. You don't have the luxury of sitting on the sidelines. Am I going to decide a direction? And buy basically or sell. And if you're bullish and you're buying and you're effectively, especially if it filters into the physical transactions, you are essentially paying the cost for things being propped up. So it might work out to begin with, but eventually it will only work out if things are genuinely there. Like, it kind of all comes back to like cash flows in the end. So an almighty bull market like last year, like the end user was just paying whatever it had to pay, and the money was just filtering into every single other like corporation within oil. So everyone was effectively winning, from the refiner to the producer, and even the utilities were passing on the costs. So and charging a margin. So everyone in the energy space was making money. This time round, it's not as easy, like you're saying. It's a lot more complex, Ehsan. So if it really is genuine, then the oil market should be okay, if you like. But there's a lot of like money being lost on hedges. There's a lot of money being lost on like the naphtha complex, for example, distillates at the beginning of the year. There's a lot of basically failures in the market, apart from gasoline, I would say, that has actually performed. So maybe that's allowed kind of some of the majority of the market to kind of, if they put their cards in there, that's kind of followed through.
I think especially like in the gasoline market, like from the beginning of the year, it had so many cycles of going up and coming down that, right, like look at Brent in 2022. It was one-way flow. It was going up. So whoever got in first, they were making a lot of money, and that was it. But I would say in the gasoline market, there's been at least like 5 opportunities like that since the beginning of the year, that we had a decent rally, everybody took profit, and then they go again. And that generated a lot of cash, obviously, for all of these market participants that are active in gasoline. Similar stuff is happening, even cross product, like something like GasNap, followed the same sort of cycle. And we see it all the time, people buy, it goes up 200. Okay, that's a good psychological level. Either naphtha rallies, creating that liquidity opportunity for people to come out of their position and book off the profits, and they've been able to play this game like a few times this year, which made them a lot of money. On the crude side of things, I'm not too sure that like whether that was more like,
I don't think the crude market is doing that well, because so much, the majority of the trade houses and majors were bullish this year. Yeah,
it was like they came into the year that bullish, right,
yeah.
This is going to the moon. So
unless you're selling Brent Dubai, of course.
Yeah, Dubai trade has probably done quite well, but I guess that's my point. How long can you wear these losses? That's why Q4 tends to be like the chickens coming home to roost quarter, like bullish or bearish, right? Because it's like whatever people have been trying to do in terms of their view, effectively by the complexity, they've ended up paying for it in some way, if it's been propped up or propped down, whatever. So that should come into light. I think the second half demand story was like the main kind of narrative. Only gasoline you could really argue that for, or I guess you could say fuel oil cracks, but again, quite clearly on the back of OPEC cuts.
I want to actually bring it. I want to bring in, because I was discussing this with one of our senior traders here regarding the CTAs and index fund traders and ETF traders, and it was quite interesting that like. And he had a background in banks, so it was just going through exactly like what they used to be doing. So essentially, at the beginning of the year, you've got some sort of mandate that, right, you've got, I don't know, 50 million, 100 million, 200 million, whatever. And you basically create a basket of like all the products that you want to trade. You have a bullish view and you have a bearish view on certain things. But what happens is throughout the year, as your individual components are making you money or like losing you money, you start like reducing a little bit of cutting on the losers and then adding to your winners. And when it becomes Q3, then like it will become kind of obvious that you have an abundance of position on your big win position, and like you've cut down a lot on your losses, or you anticipate to cut down further on your losses when you go into Q4. So for example, Brent this year, anybody who had like a big chunk of money that they put in Brent, they've been kind of wiped out, because like the Brent has not been performing. But going into the end of the year, you might see further pressure because they need to further cut on the losses that they had throughout the year, and then that money needs to go somewhere else. So it could be natural gas. There's the cyclical nature of natural gas, and bullish stories with regard to lack of material, stuff like that. So it seems like going to the end of the year, and when it becomes to like bonuses and like closing down the book and starting fresh next year, we could see further pressure
unraveling
coming onto the biggest loser of the year, which is Brent.
Financial flows versus the fundamentals and supply and demand.
You mentioned that gas. The not counter, but just, I guess that is a bit of a potential support because there are a couple of headlines coming out about being worried about winter prices this year. And then we have rallied back up to around 40 on TTF, which is, it's psychologically significant, I guess. That is a little bit of a worry, right? Oh, not a worry, but propane supported naphtha being supported off the back of nat gas. That's still a possibility. So what we're just basically saying is somewhere, whether it's the physical fundamentals side of it or the financial side, somewhere's got to give at some point by the end of the year. And if it is going to be this bull story, it's cash flows at the end of the day. So I guess we should probably finish on like
allocation of money.
Yeah. So macroeconomics we've just kind of ignored for a while. It feels like the market people just don't talk about it as much as they did. The interest rate stories are getting a little bit tired and old.
I think that was just 2 weeks ago though.
That's like a lifetime.
That's like a decade in there.
Leave a position on for 2 weeks and see what happens.
It's game over.
Fair point. But I guess what I'm saying is that like now it does feel like potentially this recession stuff was a bunch of bollocks, and that's classic, right? Everyone talking about everything, usually it doesn't happen, and everyone was talking about recessions. So if that somehow doesn't happen as well, that is genuinely how the global GDP can pick up enough to absorb and finally get the demand increase that the world was expecting, or at least the oil world was expecting, to carry it through on the bull side. So that's probably the best chance I think the oil market has got to follow through, is because this supply cuts, I mean, maybe they can keep going forever, but $5 to $10 billion extra a month losing on doing cuts, that's going to eat into any economy. So how much longer can that happen? We need the incremental demand increase, which may come from the GDP increase if the recessions don't happen. That's all I've got to say about that. But yeah, thoughts?
Yeah, I was as a devil's advocate, I would say there would, if I was a bull, I would still be somewhat optimistic because, of course, Ehsan talked about the financial flows argument, which something has to give. But of course, now we're not seeing the demand coming through. But so how do we engineer how do you support the market? That's got to come from the supply side, which is what OPEC is currently doing. But at the same time, looking at the US oil rigs numbers, it's been slowly coming down for the last few months, and because of course it's a delayed reaction to price action. Prices have been coming down.
So you're bearish US shale oil production?
Bearish because that's in the numbers. So the actual lower production figures would materialize towards the end of the year, which would be Q4, coinciding with the famed increase in the famed Q4 demand.
Well, that's the maintenance season anyways, right?
It would be so potentially that might create some supply tightness, and if there was some increased demand during that time, then the market would be naturally propped up, and that's a bullish argument.
Yeah.
On the supply side.
Yeah, I mean, I don't see it, to be honest. It's these arguments have been made like time and time again, and like the prices are not really reflecting, the bets are not reflecting, but a sudden disruption could really because market is looking for a direction at the moment. So the way I'll put it is, market is looking for direction. There is a lot more probability for the prices to go south for me But because you're in a market that is looking for direction, a sudden disruption or like a real material change could mean that we're back on the bull's back, and we're gonna see a bit of a rally. I don't give it that much weighting, but it is a possibility.
Not very conclusive, but I think that's the whole point of what we're saying. I think what we're both saying is it was set to fall off a cliff. Everything was pointing towards that, literally Thursday. And then
it was interesting. It was Friday, end of the month, end of the quarter, end of the financial year for some institute.
Yeah.
I was waiting for a Black Friday event sort of thing.
Stats was bullish though. On Wednesday.
Stats was bullish, but my point is when it becomes like a special date, like a few things happening at the same time,
create momentum.
And also it was before the 4th of July. US being out of the market. Like I don't know, yesterday volumes was not actually bad, because I thought it would be.
Today's the 4th of July.
Yeah, today's the 4th of July, but I thought that because it's the weekend and then Monday and then Tuesdays. So there's like 4 days people are going to be kind of out of market, not be trading that much. Yesterday, liquidity and trading volume was good. But like all of this stuff, when I put it together, it felt like something is going to happen in for the expiry. It didn't really. Like I don't think that was. It was a surprise that it was.
Yeah. So just actually on that, like let's say it does break past this moving average. We get the spur of buying, but like that's what $85 or $90. Now, what your argument is about oil rigs in the US, and now Saudi at like the depth of their cut, they can produce 12, they're producing 9. Russia, same thing, like not wanting to cut. ADNOC not wanting to cut. Like, everything's already at the extreme of cuts. Surely they just come right back with production. No,
they could always increase production to.
I'm sort of saying they could. Surely they would.
But then that would be more bearish on prices, right? But then
that's what I'm trying. That was our point. It's like you can do it. You can prop it up as long as you're willing to pay for it.
I was hoping for someone else to say this, but Iranian barrels are at all-time highs as well. So
exports, right? Isn't it?
Yeah.
I read that's got to have no impact on the market. So I just
I disagree.
90% of the market likes to be bullish no matter what, as the hate on Twitter shows. So anyway, I think we'll leave it there because that's a lot, but really, really interesting. And all some good points, all points raised. We love comments, guys. So please, on YouTube, whatever, reach out, let us know your thoughts. It's a very interesting time, which we're happy to see at the very least. So we're going to leave it there. Next week, we've got a slightly different podcast. Again, I'm going to be joined by my co-founder, Omar Khayyam, to talk a bit about where we are and where we're going with Onyx. And I'll see you then. So thanks for listening.